Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Global equities rally fueled by Fed rate cut bets as Governor Christopher Waller says he's advocating for rates to go down, but European and US futures are now slipping. Google parent company Alphabet rose in late trading, while Nvidia dropped after reports Meta is in talks to spend billions of dollars on the search giant's AI chips. Plus, we'll bring you results from EasyJet this morning and speak with the airline's CEO. This, as sources say, London Heathrow's proposal for a third runway is set to be approved by ministers ahead of the UK budget tomorrow.
In the meantime, a quick check on these markets here. Starting to take a little bit of a breather when you look at the futures picture coming off of the rally that we saw yesterday. Euro Stoxx 50 futures down 0.3%. Over in the States, a similar story, down about 0.1%. Keep one eye on the bond market. The Fed very much in focus. A 10-year yield that's really headed right back down to 4%. At the same time, it's the countdown to the budget. We're looking at cable at 131 this morning. The countdown to the opening trade starts right now.
Tuesday morning, good morning. All I want for Christmas is a rate cut. That was certainly the message that we got yesterday from the markets, loud and clear. The doves are out in force, and the market loved it. Yeah, we're rolling over a little bit this morning, but wow, that was a rally yesterday.
It absolutely was. And this is piling on. This came after Friday from John Williams talking about the need for a rate cut. And going into all the dovish talk, it felt like the consensus was moving in the opposite direction. So this means more. I should say, though, the comments we're getting from Chair Waller, we got to take with a grain of salt. He is one of the shortlisters and one of the contenders to be the next Fed chair. And I think Scott Bessent yesterday narrowed down the list even further. Now there's only 3 candidates, and Chris Waller is one of them.
Mary Daly, seen as being quite close to Jay Powell. Yeah. John Williams, seen as being quite close to Jay Powell. Is Jay Powell sending a message to the market? The blackout period starts on Friday. That would maybe be the narrative that I think the market is latching onto here. It is clear that the market desperately wants a rate cut.
Yes, and some people making the point that nobody at the Fed has come out to correct the interpretation that was given to those Friday comments as being sort of pro-risk, and no one's come out to sort of speak in any other way about the rate cut expectations for December. So that in itself interesting. I thought Daly was interesting in this conversation about non-linear drops in the labour market and that being increasingly a concern, because we had heard so many comments, to your point, Kriti, about inflation, lingering inflation concerns in recent weeks. And that narrative just seems to have pivoted a little, despite all the darkness in the data, the blackout in the data, the fact we don't have the full picture.
There's 2 camps. There's obviously 2 camps in the Fed. The question is, which one does Jay Powell sort of err towards? And is that what we're going to see? Because he came out and surprised the market in the last press conference after the last rate decision, and he was clear and quick to be clear that there is a divided Fed here.
Yeah.
But does it slightly err one way or the other? How divided is it? Does it mean we can get a rate cut? Does it mean we can't get a rate cut? That's kind of, we're dancing on a pinhead here in terms of where we are.
Money markets seem to be increasingly convinced, though, don't they? I think, what is it, 90% chance now that we
get we were at 100 and something. It's come down very rapidly and bounced.
Yeah. And plus, with the all background of the repo funding pressures as well, that's something that our very own Valerie Teitel has been warning us about for a couple of months, especially going into year end when you're already getting some of the tightening of the balance sheets as well. I think it's also crucial, though, is this market too dependent on the possibilities of rate cuts, or is it a completely different narrative? Is it tech? We've had guests on the show who've talked about it both ways, that the Fed is greasing the wheels of the tech rally. And maybe that are 2 separate issues. Let's talk about tech.
Yeah, let's talk about tech. I mean, John Orther's talking about the Greenspan put being back, but we'll pick up that conversation perhaps later in the show. So tech. I'll start with the big picture. I've read some commentary this morning suggesting that the reset we've had, or the sell-off, you could call it, in tech and tech valuations is maybe setting us up for something more positive in tech in December, some kind of Santa rally, maybe. We will see. But in terms of the overnight news flow, or yesterday into overnight, because this is still having an impact on the Asia session, Nvidia down, Alphabet up. Alphabet's role, increasing focus on what they're doing in the chip space, in the TPU space, as opposed to what Nvidia is selling. And that seems to be what Meta is going after. And so this has been a bit of a negative for Nvidia. And you can see it in the Asia suppliers. So Asia suppliers to Nvidia down overnight, Asia suppliers to Alphabet up overnight, as if the market is taking this kind of reporting really quite seriously, all coming on a day when we're really focused on AI because because Alibaba also reports.
The market, you could argue, and by extension the US economy, is largely built on Nvidia's outperformance. the fact that NVIDIA is going to continue to perform very strongly and be able to deliver the kind of margins that it has been delivering. It is feeding the data center story, which is feeding the US economy. If that starts to falter, if those margins are questioned, if NVIDIA can't fulfill that role, then that, I think, is a big question. Then you've got the kind of OpenAI relationship, which I think is interesting. We were talking about SoftBank before we came on air and what's happening there. Big hit there. If NVIDIA, by extension, and OpenAI are struggling, how does that change the ecosystem and this circularity that is built into it at the moment?
That's the NVIDIA piece of it. There's a geopolitical piece to this as well, in that, and Bloomberg put out a great story this morning talking about just how much of the fiscal boom is tied to those AI investments.
Yeah.
Some of that is the partnership between Jensen Huang and Donald Trump, frankly. They're talking about 21 trillion. I think it's trillion. 21 trillion. That sounds right. 21 trillion of promised investments from the Trump campaign, only of which 7 trillion are actually looking to manifest. But if you look at the category, it's all AI, it's all chips, it's all manufacturing.
That's what I mean about the US economy.
Yeah.
That's the US economy link.
But if NVIDIA loses to Alphabet's gain, that would be one thing. But if it loses to China's gain, that would be another. And that's why I think it's really interesting, the advancements that Alibaba is making with its rival product to OpenAI, Quen, just launched yesterday, really strong demand, and so that puts the focus on them as well.
If there is competition, are there lower margins? So at the moment, NVIDIA is making amazing margins. You saw it. The results were amazing. The results are sensational. And there is a kind of question around demand in being asked about NVIDIA after those numbers. But nevertheless, the numbers were sensational and the margins are sensational. But if you've got a choice, we start getting kind of trade-offs and margins come under pressure. And that's where I think kind of the NVIDIA valuation will be questioned. But you can take it back to the Fed as well. Fed rate cuts will help. If you want a high multiple, Fed rate cuts certainly deliver. Let's talk a little bit about EasyJet. It's quite a pivot, I know, from the chip space to EasyJet, but we're going to do it anyway. You've got EasyJet numbers out this morning. The numbers look all right. I think the dividend is a little light in terms of what Bloomberg was expecting. The question now is what happens over the winter. I think there's a big question about what happens in terms of the demand picture post-budget. Going into the budget, I think, is an open question as well. There's a Heathrow story floating around this morning about the fact that the government has apparently greenlit Heathrow. I speak to very few people in the airline industry that think that Heathrow can have a third runway at a cost that is...
They see only costs.
They see you've got to move the M25, for heaven's sake.
I know. At the risk of sounding like somebody else's talk radio, that sounds expensive.
It's very... Anyway, it sounds expensive. So EasyJet doesn't operate there, so it's a Gatwick story and other airlines as well, and other airports as well. But it's going to be interesting to see what they say about the demand picture. We're going to speak to Kenton very shortly. Kenton Jarvis, the CEO of that airline. What is he going to say? Now, remember, people like Michael O'Leary have been pushing very hard for the budget to deliver cuts to airfare duty. He would like to see that happen. It's unlikely to happen. This looks like it's going to be a tax-raising budget. So we're in the kind of final countdown into that budget now. Excited is the wrong word. Trepidation, maybe.
Yeah.
The latest is on ISAs and all kinds of things like that. We're in the weeds.
We are in the weeds now. The latest, we're going to get that drip of news or leaks.
We've had it for months. What are you talking about? It's been going on for...
Maybe it turns a little more into a torrent, but limited on cash ISAs to £12,000. That seems to be the latest newsline overnight. That's the focus. Elsewhere, there's a focus on what's going on with FX markets. Are we going to see traders trying to protect themselves from downside in the pound? I think they start protecting themselves from volatility and gilts. All of that conversation, no doubt, still
Do you
ahead.
buy UK banks this morning on the idea that maybe they're not going to see a further levy being attached to them, but if they do see that happening, they don't get to say negative things about the budget? That's what the FT is leading with this morning.
They're also talking about, in the FT, but also our own markets reporting, suggesting that people are really piling in on the shorts when it comes to the pound. So maybe we do see some sort of bigger drop down. We're looking at 131 at cable. It's kind of been floating around the 130 level.
So I was thinking about this. Is there the opportunity, if people are short going into this, that actually it's not quite as bad and actually you get a bit of a short squeeze in the pound, which would paint a more positive picture than maybe the budget actually delivers,
and it was
just because of positioning.
The protect against the weak pound argument was all about weakness in the UK economy, and I just wonder whether the immediate growth prospects for the UK are going to be the thing that the market focuses on. Thank you.
What growth?
Well, but is that going to be the focus, or is it all going to be about debt markets? In which case, the pound might have a different reaction function.
I think it's just a positioning. It's just a positioning argument, which I think is going to be fascinating. And you can kind of see that on the screen at the moment, how the market is set up going into this. Anyway, let's talk about what we're going to be doing. What is it, tomorrow? It is tomorrow. Finally, we're there. We're almost there. The UK Chancellor, Rachel Reeves, is expected to deliver her budget at 12:30 p.m. in London tomorrow. We will, of course, bring that for you live for UK and European viewers. Full coverage and analysis as it happens around that budget. It doesn't, of course, stop there, though. The opening trade will break down the numbers with key business and political voices in our budget special, which is happening first thing on Thursday morning. What have we got coming up on this morning's show? We're getting a little bit ahead of ourselves. Anne Whitty Bahuguna, Northern Trust Asset Management Global Co-Chief Investment Officer, is going to be joining us. Helen Miller is from the Institute of Fiscal Studies, the director there. We'll get her take on what is happening here. Kenton Jarvis, as we've already mentioned, the EasyJet CEO, is going to be joining us. That's just kind of the first wave. Second wave looks a little bit like this. Hugh Gimber, JPMorgan Asset Management Global Investment Strategist. Florian Duetto, the Dataiku, not IQ, I think is the way to pronounce this. CEO is going to be joining us from Paris. And then we're going to be speaking to Rupert Harrison, PIMCO's senior advisor for the UK, a little later on the show. Let's
talk about plenty of data and other kind of tradable points you want to keep an eye on as well. We do have an auction coming up in just under 2 hours here in the UK. £4.5 billion worth of Treasury gilts due to hit the market. Plus, of course, plenty of data coming out of the States later in the day. 1:30 p.m. UK time. September retail sales, some delayed data hitting the wire. Plus, of course, those US PPI numbers. And then we are back in the thick of earnings. We have Alibaba later this morning, UK time, HP and Dell after the bell in the States.
What else do you need to know this morning? Let's figure it out. Russia and Ukraine have exchanged fire overnight. This, of course, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Russia launched a wave of heavy air raids on Ukraine's capital, Kyiv, while the Russian Black Sea coast region suffered sustained damage, we think, from drone attacks. The EU's antitrust chief has ruled out easing the bloc's tech rulebook. This after the US Commerce Secretary Howard Lutnick said Brussels needed to change its digital regulation in order to get a deal on lower steel and aluminium tariffs.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
Another factor in yesterday's bounce, maybe the following story. President Trump and his Chinese counterpart, Xi Jinping, have held their first talks since agreeing last month on a tariff truce. President Trump said the call was very good and touched on issues such as trade and Ukraine. He also says he will visit Beijing in April and that he has invited President Xi for a state visit next year. But the White House readout of the call did not significantly mention Taiwan. A Chinese Foreign Ministry statement says that Xi told Trump that the return of Taiwan to China is a key part of the post-World War II international order.
Yes, I mean, that was what was really interesting, wasn't it? The fact that the readouts from the two sides had very different emphasis. The US side emphasising trade, the Chinese side emphasising what's been said on Taiwan. On the subject of Taiwan, we've got further comments coming through from the Chinese this morning. China asking airlines to extend their Japan flight cuts until March, so an extension of what's previously been initiated by the Chinese with regards to Japan. And we've seen this point of tension many times, and we've seen it being exercised through trade and restrictions on people's ability to trade with each other, in this case aviation, in the past. But what's really interesting is the extent to which we have not seen much progress on China-US relations. I mean, they haven't deteriorated with this phone call, but there hasn't been much progress, and we still don't have the rare earth deal. You know, the finer details of that still being ironed out, and Besson had said he wanted it by Thanksgiving.
Yeah, it's fascinating one that this is getting kind of entangled here, because just at the same very moment that Donald Trump is trying to perhaps extend that olive branch to China, he also just made a big show about the partnership with Sanae Takaishi on, I think it was the USS George Washington in the Pacific. And it was this big, big show of strength. So what side do you kind of lean on?
He's trying to balance the boat. He's trying to balance both, isn't he? He basically doesn't want to erode the China deal.
Yeah.
But he needs also to make sure that, as you say, that relationship with Japan continues in the way that it has been developing.
Which is such a big part of the American defense strategy in the South China Sea.
So he's got a tricky deal to manage here, I think. And I find it interesting that the Chinese are talking about this going on, this flight ban going on until March. So this is not something they see being resolved kind of quickly. They're not doing it on a kind of week-by-week, month-by-month basis. Like, it's the spring. That's the next time we're going to take a look at this.
Yes, it is interesting also, though, on China-US relations that we do have plans in place for Trump to go to Beijing in April, and President Xi has been invited to the United States later next year. So we'll see whether the Japanese relationship and what has been said around Taiwan has the ability to throw that the relationship between the two world's largest economies off track or not. We'll continue to monitor. Coming up on the programme, back to corporate news, and ABN AMRO Bank plans to cut 5,200 full-time roles by 2028 as the new chief executive officer, Marguerite Bérard, unveils her vision for the lender. We'll check in on the share price reaction at the open. Plus, we'll have more on those EasyJet earnings. We'll be speaking, as Guy's been saying, to the airline CEO, Kenton Jarvis. That conversation coming up later this hour. Up next, though, we dive into the markets. Fed rate cut expectations to the fore. We'll talk to Northern Trust Asset Management's global co-CIO. If you have any questions, please get in touch. IB plus BBTV Go is the function to use to do that on the Bloomberg terminal. This is Bloomberg.
Tuesday morning, good morning. This is what futures look like. Yesterday was an incredible day. I think you've just got to bear that in mind. In some ways, what you see on the screen in front of you doesn't really bear any kind of resemblance to the reality of what we've seen over the last few hours. Markets are sharply up, and the reason they are sharply up, well, there's a number of reasons. Trump, Xi, you could argue, what's happening in tech, but actually probably most relevant is what is happening when it comes to the fares. Christopher Waller out yesterday signalling his support for a December rate cut. Now, he's been on that camp. He's been on that box for quite some time. He spoke to Fox Business yesterday, very much though echoing earlier comments from other officials, including in the Wall Street Journal, San Francisco Fed President Mary Daly.
My concern is mainly the labor market in terms of our dual mandate. So I'm advocating for a rate cut at the next meeting. We're going to get a flood of data that's released, and if it's kind of consistent with what we've seen, then you could make the case for January. But if it suddenly shows a rebound in inflation or jobs or the economy's taking off, then it might give concern to at least, look and see or be more cautious. So I think just because of that, you may see more of a meeting-by-meeting approach once you get to January.
Meeting by meeting. Next Fed chair? Maybe. Anne Whitty, Bahuguna, Global Co-Chief Investment Officer at Northern Trust Asset Management, joining us around the table. Good morning.
Morning.
December?
Yes, definitely in the cards.
On the cards or a racing certainty now?
Given the statement by Waller just now and Mary Daly, it's getting very close to near certain.
Yep.
And one factor to consider is that once the market probabilities are this high, Fed follows through.
And December's the blackout. Sorry, Friday's the blackout period for the December meeting.
So they have a few more days to correct course.
Yeah.
Otherwise, if the probability is 70, 80...
Let's get a bit more nuanced. What kind of a cut will it be, though? Because Waller's talking about kind of meeting by meeting beginning of next year. Is it going to be a hawkish cut? I.e., will Powell have to recognise there are those on the FOMC that are still concerned about inflation?
Absolutely. Absolutely. I think it'll be a cut that comes with a statement that from here on, we are meeting by meeting. We are watching inflation numbers.
Yeah.
They are rightly so worried about growth at the moment, on the labor side, I mean, with the unemployment rate picking up a bit in the last data. And then we have this gap of data where some of the data releases won't be available until after the December meeting. And so they can really afford to wait and see, is the labor market deceleration continuing, or are they now seeing more of a pickup in inflation?
To what extent, though, given the choice, if Jay Powell does have to take this massive U-turn from the hawkish tone he's taken previously, does that erode his credibility and, by extension, the Fed's?
Markets have been questioning that for quite a while now, saying that how can the probabilities reflect a change from 30 earlier in the week to now 90, that it's flip-flopping quite a bit with very little data to back it up.
Yeah.
So it's very much, are they positioning for all of next year? What is 2026 going to look like? And we've just sort of published our 2026 outlook, thinking through how much more they can cut. Because remember, they're not cutting because this is a big growth scare in the U.S. In fact, many are questioning why they're cutting at all when growth is in the sort of 3% handle and inflation is also well above their target. So they're likely to position that we think neutral rate is somewhere lower, policy is still restrictive, we're going to cut once in December, then it's meeting by meeting, and then let's see how the data pans out for the remainder of 26, which we think will afford them a few more cuts.
Well, to your point about this data, why not lean into the narrative of an insurance rate cut? Why has the Fed not pressed that button more?
Well, that's an interesting question. It is indeed exactly that. It's an insurance rate cut.
They just refuse to brand it that way.
Yes, it's more that they're well above their perceived neutral, which is around 3%. And growth in labor data has indeed moderated enough for them to have something to latch on to for insurance. But it is an insurance rate cut.
But you have not given up being worried about inflation, though, Amriti. I mean, I noticed that you talk about inflation averaging at 3% next year and your overweight inflation protection assets.
Absolutely. We are quite concerned as inflation being one of the most significant risks for us in 2026. As I mentioned, the inflation rate is not back to the target. What concerns me is that we are also going to see a little bit of fiscal spending from the U.S. administration in 2026. Trump's been talking about his $2,000 checks as a tariff payback to the consumers, which is spending, really. It's fiscal spending. On top of that, we really are seeing cuts in an environment where economy is likely to accelerate again.
And where does a rate cut into a tech stock boom, give or take, last couple of weeks or so?
Yes.
But where does a rate cut into that kind of boom for US tech? Where does that leave us? Where does that leave your US weightings versus elsewhere?
So I would say that beginning of this year, in 2025, I used to think, well, tech stocks are not really concerned about the interest rate environment. That's more relevant for cyclical stocks. That's more relevant for small caps. But you've seen a bit of tech spending that's now not funded by their cash flows alone, and they're raising debt. So it is starting to be relevant for tech stocks also, since they're going out in the market and raising debt too.
How important is it that NVIDIA keeps spending money or kind of driving an ecosystem for the US economic outlook? How important is that data center build out, and how important is NVIDIA to that data center build out?
So I think this year, for the first time, Guy, we saw the capital spend by the hyperscalers, by the tech semiconductor companies actually show up in GDP data. It was significant in the first half, where the first half we were expecting a sort of negative print for technical reasons, and in fact we got a positive one, solely driven by about a near 1% contribution from capital spend. I think it is important, but ultimately US is still about the consumer, and if you don't see unemployment rates pick up, we don't absolutely, I mean, it's marginally helping. It's not the only important factor.
Fascinating. Fiscal spend, a little bit of tech in there, and all the Fed. The view, of course, from the Global Co-Chief Investment Officer at Northern Trust, Amriti Baguna. We thank you so much for your time around the table. Coming up on the program, we're going to continue the fiscal conversation this time on this side of the Atlantic, especially as we build up to tomorrow's UK budget. Helen Miller, Director of the Institute for Fiscal Studies, joins the program next. Stick with us. This is Bloomberg.
Good morning. Welcome. Tuesday morning. I think the party's over, at least for now. Yesterday, everybody was partying. Everything was having an amazing session. Today, maybe we're a little bit more cautious. Euro Stoxx 50 futures down by 0.1%. FTSE futures down by 0.1%. The CAC's having a slightly more positive day, but I'm not entirely sure that that's a party. What we are, though, is dealing with is a little bit of a hangover from a very solid Fed-driven session yesterday. And that kind of is the narrative we're dealing with first thing this morning. The bond market was interesting as well yesterday, though. yesterday. It wasn't just equity, it was everything moving yesterday.
I mean, just the fact that we're looking at a bond market that's now headed back to 4% and potentially sub 4% is
on
pretty,
a 10-year.
On a 10-year is pretty, on the U.S. 10-year is pretty significant, just coming off of just how sensitive this market is when it comes to some of the commentary we're getting out of this Federal Reserve. That being said, whether or not it's flowing to Europe is a completely different story, virtually unchanged on the European bonds this morning. But keep an eye on it. I think we're awaiting some comments coming from Emmanuel Macron later in the day as well, some radio interviews there. There's definitely one eye on Germany, one eye on Ukraine. That is likely to feed into the fiscal picture.
Absolutely. So all of that potential for fiscal news flow could impact on European bond markets. We'll wait for the gilt market open in half an hour's time to see where the mood is a day before the UK budget. Of course, that UK budget will be delivered by the Chancellor of the Exchequer tomorrow. A lot of expectation that we will be getting some tax hikes this time around. Let's talk about the fiscal choices that lie ahead of the Chancellor. Helen Miller joins us, Director of the Institute for Fiscal Studies. Helen, very nice to have you with us. Thank you for your time. So there does seem to be this expectation that we will get tax rises, another budget with tax rises in it. Is there a way to do this that is better than another way? There's a lot of focus on whether you just do one tax increase or whether you do many piecemeal small tax increases, and views seem to differ there. What's the IFS view on that?
So I think there's not one single correct way, and ultimately it's obviously a political choice who the Chancellor wants to raise more money from, and therefore there's no one political right answer either. But there are definitely worse ways to do it. And I think the key fact is that the devil will really be in the detail. So if the comparison is between one larger measure or a whole subset of measures that are actually tweaks to particularly damaging taxes, then I think that you can make the case for the bigger measure. I think this whole idea of a smorgasbord has got a bad press recently. The idea that it has to be bad doesn't need to be bad. It could be sort of a set of delightful treats, a set of smaller measures that reform some other smaller taxes, make them better along the way, then it wouldn't be so bad. But if we see a set of smaller measures that are tweaking taxes that are damaging for growth, where the revenue is less certain to actually come in and that makes investors nervous, I think that is the big concern for tomorrow.
So that's on the tax side. On the spending side, Helen, this government has failed to deliver on some of the cuts to spending that it had intended, and failing to convince its backbenchers on the need for those. You've been giving a lot of thought, I know, to where the government could cut. Obviously, these are political decisions, but where it could cut spending. What do you think the focus should be on? I mean, will it be on? Will it be on the triple lock, around freezing some benefits, around the state doing less than it does at the moment? I mean, what's the focus?
Yeah. So just to pick on the triple lock, and that's a case where I think this government or any government should be getting rid of the triple lock, no matter how you want to set the state pension in terms of how it relates to average earnings, for example. The triple lock has a particularly horrible feature of having this ratchet effect. So you end up getting pensions ever upwards. So that would be a good thing to get rid of. And replace it to make more sensible. More generally, again, there are lots of options. If the government wants to tackle welfare, then there are reasons to do that in the sense that disability benefits are rising very, very quickly. That's an area to look at. But as you said, they already tried and failed to do that. I suspect they won't rush back for that. It's already the case that they are freezing benefits related to rents. So again, not much else you can do there. And of course, there are calls for the two-child limit to be removed. So there absolutely are cuts you could do to welfare. I don't think we'll see them from this government. On the day-to-day spending, the challenge of this government is that they only just settled the spending review this year. So they've set out their detailed departmental plans for the next 3 years. They could reopen that, relitigate that, unpick it. I think that's unlikely. What they shouldn't do is just pencil in big, unspecified spending cuts for the end of this parliament. The danger with that is that no one's going to think that's credible to say that a year before election you'll just get some big cuts.
Helen, good morning, it's Guy. Can I take you back to the smorgasbord? The problem I have with buffets is that I never end up with a satisfying meal. And I go to the buffet and I look at it and it's too complex and I don't really know what I'm going to end up eating and what I want to end up eating. This looks like it's going to be something similar. We're going to end up with a budget that is a smorgasbord of changes. It's going to be very complex. The situation's going to get more complex. And business doesn't need that right now. It's already too complex, the tax situation here in the UK. Is a more complex situation growth negative?
Again, devil's in the detail, but yes, probably. I mean, complexity is a problem in and of itself. And you're right, the system we have at the tax system we have in the UK is horribly complicated. Why is it horribly complicated? The short answer is that what chancellors tend to do is bolt on new things or fiddle around the edges rather than fix what we've currently got. So if that's what we see, if we see new taxes bolted on or taxes tweaked but not fixed, then yes, we'll have a more complex tax system that's good for nobody. And if that's the approach they take, another danger is that it'll be harder for the OBR to work out the revenue effects. And if people in the markets aren't feeling confident that the measures will deliver the revenues they say they're going to deliver, that's another cause for concern. So buffets can be delicious, I think, but there's danger this one won't be.
Yeah, there are some. There are a few, but there are some. Do you think this budget, how big a danger is that this budget is inflationary?
I think a relatively small danger, actually, for a couple of reasons. One is that big picture, Rachel Reeves is going to deliver a fiscal consolidation. So she's going to be reducing, either increasing taxes or cutting spending. And Rachel Reeves is on record many times as saying that she wants to help get inflation down. Having said that and pitched relatively for that, it would be surprising to see this be a big inflationary budget. So never say never, but I think it would be a surprise at this point to see that.
Helen, what is the magic number here to reassure some of these markets? When we're talking about fiscal headroom, I've seen some pretty big variations. I've heard it from anywhere from £10 billion all the way up to 30. What's the magic number that would make this budget a success?
Sadly, I'm not sure there's a magic number in the sense that, again, there's a choice. I've seen 15 billion floated. So 15 billion would be more than we've got currently in terms of wiggle room against the fiscal rules. But honestly, in public finance terms, 10 and 15 billion are the same number. They're so trivially different as to not matter a huge deal. So I think she would need to do at least that, because again, she's pitched role for the idea of more headroom. So she needs to do at least something to show that she is delivering on that. Past chancellors in the 2010s were operating with something more like 30 billion. We used to think of 30 billion as the norm. So getting back to that would be getting back to the historical average. I'd be surprised if we see something going that far, because it would mean Rachel Reeves increasing taxes by an extra 20 billion just to build that headroom. And that would obviously be politically difficult.
All right, so potentially 15 billion is kind of what I'm hearing there. What does the BOE need to hear then again? So we just talked about it from the investor point of view in terms of what success looks like. What does the BOE need to hear to say that was a good budget?
Well, again, the bank will be looking at its own forecast and thinking about whether anything in the budget today changed its expectations over inflation and the path it's setting. It's thinking it's setting for interest rates. So again, it will be looking carefully, I've no doubt, at the potential inflationary consequences and whether this changes anything for that. And at the broader picture of the timing of the different measures. So everyone always focuses on the end year here because that's when the fiscal rule binds. But actually it will matter not just what Rachel Reeves does in that end year. I think nobody doubts that she will meet her fiscal rules, but also the profile of spending and borrowing and taxes over the coming year, because that will matter for a Bank of England that obviously is monitoring things month to month and not only on a 5-year horizon.
Helen, great to catch up. We're nearly there. We'll soon be at that moment where we get the budget. Helen Miller, Director of the Institute of Fiscal Studies. Thank you very much indeed. Now, remember, the UK Chancellor is expected to deliver her budget tomorrow, circa kind of 12:30 p.m. London. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. We're also going to have an opening trade special the following morning to break down the numbers. We're going to talk to key business and political voices. That'll be our budget special on Thursday morning. Up next, what does Kenton Jarvis want out of this budget? He is the EasyJet CEO. He's just dropped his numbers. There's interesting things to talk about here. We'll be back with him very shortly. That's next. This is Bloomberg. "17 minutes to the market open. EasyJet's stock is going to be in focus this morning. I suspect the company out with numbers first thing this morning. Headline pre-tax profit coming through at 665 million, slightly ahead of estimates. The dividend a touch light in terms of the estimates we had, but a big pickup in terms of that dividend. The revenue per seat, £83.3. Again, just a touch shy. One of the most significant factors, though, in the numbers this morning is that they have raised the holiday business target for 2030 over at EasyJet because they've met the near-term targets a little earlier than anticipated. The company's CEO is Kenton Jarvis and joins us now. Kenton, good morning. Thanks for bringing us the numbers. Thanks for being on the show this morning. Where should I be focusing in terms of these numbers? Is it on what is happening with the top line, what's happening with revenue, or is it what you are doing with costs?
Thanks, Guy. Well, revenue did grow. We increased our turnover to just over 10 billion. But this was our third successive year of earnings growth. And since we set our medium-term targets in full year 23, we've increased our profit before tax by 46%. And this year was another good year, increasing earnings by 9%.
In terms of the cost story, though, how big a struggle is it? Because those numbers could look better if there wasn't a fuel issue, if there wasn't an ATC issue. How big a factor is that? How easy is it to manage the cost line right now? I hear what you're doing on revenue, but is it actually the cost line that's holding you back?
Well, the unit revenues have actually stayed flat for the last 2 years. They were flat again this year. What we've done, and it impacted the winter, was made quite a considerable investment into resilience measures, so we could set up for what we expected to be a poor air traffic control environment, particularly above France. And the French did not disappoint there. But because of the resilience measures we have put in, we actually saw an improvement in our punctuality. And we also saw, really pleasingly, that customer satisfaction increased by 4% up to 80%, which is the highest level we've had in over a decade. And as a consequence, our resilience, our kind of disruption costs came down almost 50 million on an underlying basis. So the investments were made mainly in the second quarter to set up for the summer, and they really came through.
What does the winter look like? You're talking about enhancing consumer choice and driving productivity and utilization. Is that what you're really referring to there, that ability to manage through some of those issues? What does the winter look like? What are we going to see? Why is the consumer experience going to be better? Just give us a sense of what demand looks like right now and how that's going to reflect again through the winter in terms of your numbers.
Sure. Well, last year we flew 3.7 million more customers, and EasyJet Holidays grew the business by 20% more customers. As we look forward into next year, EasyJet Holidays is anticipating a 15% increase in customers, so still a healthy growth from obviously now a larger base. And as an airline, the most visibility we have are over our first 2 quarters. The December quarter, we're 81% sold, and we've actually we've taken 1.4 million extra bookings compared with this time last year, so we're better sold as a percentage of the seats on offer. And for our second quarter, still quite early for the quarter to March, we're 26% sold, but again, we're better sold than we were this time last year. So the consumer is still there. And we'll have to wait to see, especially in the second quarter, how pricing comes through. But it's competitive as always.
Well, Kenton, you mentioned the second quarter there. Let's go a little bit beyond that. For all of next year, talk to us about what your fare picture looks like. Are we looking at rises?
So in full year 25, the year we've just had, our average fare was £74, and the year before it was £73. So pretty flat fare environment for full year 25. The first quarter, we're seeing fares broadly flat year on year. And then for the second quarter, fares are up a little bit, but it's quite early, so we're some way away from the late selling period.
Well, sticking with what's going on next year, talk to us a little bit about fleet deliveries. And we've previously talked to you, about deliveries when it comes to Airbus. How are you seeing that timeline play out into 2026 and beyond?
We're growing in confidence with the deliveries from Airbus. We said this time last year when we announced the results, we said we expected 9 aircraft to be delivered in full year 25, and then that would rise to 17 the year after, then 30, then 43. And I'm pleased to say we got the 9 aircraft we anticipated, and we still have expected delivery schedule from Airbus is 17, rising to 30, and then 43. So we haven't actually had a change in the delivery schedule over the course of the last 12 months. So the production chain seems to be unlocking a bit.
Kenton, good morning. It's Anna. You've previously said there's nothing to add to speculation about whether whether another company is going to buy EasyJet, which we understand. But these kind of rumours just keep on coming back to the extent that one day earlier this year, your share price went up by 12%. Talk of MSC possibly coming through with an offer. Why do you think all these rumours keep coming?
Well, there has been consolidation in the aviation sector. We've seen the big three aviation groups of IAG, Lufthansa Group and Air France KLM buying some of the smaller flag carriers. We know in Portugal, TAP is a target. We've seen all three go for Air Europa. SAS has been bought by Air France. So, you know, this process continues in the flag carrier space, and when it came to EasyJet, it was in fact pure speculation. There was nothing in it, and as a manager of the business and my management team, we just remain very focused to keep building on the earnings growth that we've had over the last 3 years and drive forward to our target of sustainable profits over $1 billion.
Could you see it making sense, Kenton, for that consolidation story to extend into the low-cost airline space, though? I mean, Michael O'Leary talks about that their business many times larger than yours. You're a few times larger than Wizz. Would it make sense for consolidation in the low-cost airlines?
It's not in my plans. My plans are to remain focused on improving the customer experience and improving our earnings year on year, and that's what we'll focus on doing.
Kenton, any thoughts on the budget? Budget tomorrow? Anything in it for the aviation sector, do you suspect?
Well, I hope there's some consistency in the budget. The government have been very pro-aviation and pro-growth. They really recognise the valuable role that aviation plays, especially to an island economy, in enabling growth. So I would hope that there is some sort of freeze or even reduction on air passenger duty, because last time we saw a reduction in 2023 on domestic APD, EasyJet added capacity, other carriers added capacity, that increased the connectivity, increased the consumer choice and brought down fares. And I think that, you know, that kind of action would be very encouraging, but we'll have to wait and see.
OK, Kenton, thank you so much. Thanks for your time. EasyJet CEO Kenton Jarvis. Let's broaden the lens, talk about the markets in 3 minutes. Our Markets Live executive editor Mark Cudmore joins us now. So strong gains in stocks globally, US into Asia, Mark, as a result of what, the Fed rate cut theme. Does that live on? US futures have rolled over a little.
Yeah, I think that the sell-off that we started in stocks about 4 weeks ago is still not fully exhausted. I know that's been a kind of repeated refrain of mine for the last few weeks. I understand why people are rushing to buy the dip very quickly, but it just doesn't feel like that the pain in the digital asset sector has fully played out. And sure, there's not a direct transition, but that is weighing on the margin on some of those popular retail names and some of the most popular momentum stocks, and that is dragging on the sector. I don't expect a major pain, and as we've talked about a lot, I think the AI bubble will continue to inflate very, very strongly into 2026. I am just not convinced that we're ready to get right back on the bubble bandwagon already. I think from here until Christmas will continue to be difficult and not the usual Santa rally.
Does it matter, though? AI, yeah, that's obviously a huge market theme. But as long as the Fed's cutting, who cares?
I think that ultimately the AI theme is much bigger. It's what drives the US economy. It's driving all the biggest valuation stocks in the world. So for markets, the AI theme matters much more. It is true that at the moment, there seems to be a very outsized reaction, surprisingly so, to small moves on whether the Fed cuts by 25 basis points or not in December, which seems kind of ridiculous. I actually think that, Powell's got the votes to probably push through a cut at the margin. I think that's the way we're going, and that will help the stock market. But that's not coming for, I think it's 3 weeks from today. So, they've still got quite a bit of time. Or maybe 2 weeks from today. So you still got, until then, I think it's going to be tough for stock markets. And I'm not sure that's going to be the game changer that people are looking for.
Mark, does a cut in December mean a cut in January?
No, I don't think that's necessarily the case. I mean, clearly, if they cut in December, it's going to be super, super debated. And as I said, I understand the uncertainty out there. If you ask me now, I think it's more likely they will just about cut in December, but there's a lot of data coming in between today and tomorrow before Thanksgiving that might help kind of clarify that. But I think that even if they cut, I think it'll remain very, very difficult to have kind of consensus behind it, which means we don't necessarily follow through. The overall theme, though, going to next year is that we know this, we've known this for a while, is that the Fed is going to provide easier monetary policy than orthodox economics would suggest, and that is supportive for the stock market. Growth at the moment seems to be holding up okay, but driven by the AI capex boom. If the AI capex boom blows up, then the economy is not robust enough to hold up because it is a K-shaped economy. And that's why ultimately it is the AI theme that dominates absolutely everything else out there.
All right. Bloomberg's Markets Live executive editor Mark Cudmore joining us this morning, trying to connect the themes between, of course, the Fed and the tech space. More analysis from him and the team, all on ML Ivy Go on your Bloomberg terminal. I think it's fascinating. We're hearing two very different camps here. One, that the Fed is greasing the wheels of the tech rally, and then folks like Mark who are saying this is at the margins, this isn't the key driver.
So what is the key driver? What is it that is going to drive this stock story forward? Because valuations are already pretty punchy. Why do you continue? What is the next catalyst that gets the tech story rallying forward? Yeah. I don't know. Because a lot of things are in the price right now. Nvidia's, it feels like it's all in the price.
Yeah, and if it's all going to be increasingly about competition for either Nvidia or US tech, then where does that conversation leave us? We will see what the man in red delivers in December, if anything. We'll be back with the market open. This is Bloomberg.
How you doing? Good morning. Tuesday morning. Yesterday was epic. Massive rally. On what? I don't know. There's a bunch of reasons. The Fed, maybe the Trump-Xi call. I don't know. Whatever it was, the market clearly wanted to go higher and did so with gusto. The dip buyers were in. You can see it yesterday. Yesterday's session, the S&P was pretty strong. Most of it, though, was front-loaded, which I think is interesting in light of what Kriti's about to show you in terms of the futures this morning. US futures are flat. Similar picture here in Europe, Kriti.
Waddling around. We're treading water, it seems. A breather, maybe, if we can kind of call it, given the green on the screen you showed on your chart earlier, because we are taking a little bit of a step back. Remember, volume, I imagine, is light. We're kind of counting down to Thanksgiving. Turkey Day over in the States on Thursday. Eurostoxx 50 futures down about 0.1%. The FTSE 100 is similar margin. The outperformer this morning, Anna, is France. And this one's interesting. Higher by 0.2%. Not a massive move higher, but in a background of red on the screen. This one's significant. One eye, I think, on politics in France this morning.
Yeah, perhaps the politics to the fore. We'll keep an eye on the French market then at the start of trade. In terms of individual stocks we're watching, we'll also keep an eye on ABN AMRO, the bank over in the Netherlands, planning to cut 5,200 full-time roles. New CEO in post, trying to boost profitability over at that business. EasyJet also in focus. We just spoke to Kenton Jarvis, the CEO, talking about growing in confidence in terms of deliveries of those Airbus jets. Consumer demand still there, he told us, and there's nothing to it when it comes to the M&A conversations. He's still focused on just delivering for the business, as you might expect. In terms of defence names, there's been plenty of violence overnight. Kyiv and parts of southern Russia. There have been meetings taking place in recent days over in Geneva, some in the Middle East as well. Have yet to see any progress, but it does seem as if the many conditions attached to some kind of ceasefire maybe aims to reduce them, at least from the European side, Guy.
OK, here we go. Let's find out what actually the market is going to do this morning. We think it's going to be a fairly flat open, but the sector story, the single stock story, is going to be interesting. So I'm not expecting fireworks. Fireworks came yesterday. Today, we're kind of just waiting for the next catalyst, I suspect. Where does it come from? Is it the UK budget? Is it more Fed speak? Remember, the Fed goes into a blackout period Friday. Anyway, I'm talking because actually there's not much happening on the screen right now. Stock 600 is up by 0.1%. The FTSE 100 is flat. We are waiting a CAC that may be a little bit more positive, but not by much. Elsewhere in Europe, maybe we get some of the defence names moving on the back of some of the news that Anna's just been bringing us, but we'll watch that one. Tech maybe continuing a little bit of upside. Is that why the AEX is having a better day? But you've also got the ABN AMRO story to fold into that as well. They've got an investor day today, and it looks like big job cuts are coming. What does that do to the cost picture? So that's where we are. IBEX is absolutely flat. We're waiting for the DAX. What are we seeing in terms of the sector and the single stock story? Kriti?
Well, it's a fascinating one. When you look at this market, it is kind of split half and half. I'm pulling Guy Johnson here, 265 versus 214. And you can see it red and green on your screen across the board. Telecom, chemicals are your laggards this morning. But when you look at the outperformers, I'm trying to find some sort of narrative here. I'm not seeing a ton of it. It just feels like yesterday's underperformers, the energy sector that had taken a hit, some of the banks that were taking a hit yesterday, the underperformers are your outperformers this morning. Tech still very much on the forefront. ASML, your biggest index contributor.
I wonder if the Fed narrative is sort of sidestepping into the European markets. I saw earlier on someone attributing the higher copper price to Fed rate cuts, and I now see that basic resource stocks are higher by 1%. Copper was higher in the Asia session. Iron ore was a little bit higher in the Asia session, but not by a huge amount. But basic resources, the best performing sector, up by 1% in this morning's session.
So what I find surprising is biggest points gainer, ASML.
I know, I was just saying, it's a tale of two tech, isn't it?
SAP is the biggest loser. So even tech is split this morning and doesn't have a sort of convincing narrative running it through. Maybe the chip story is more positive. Novo's up, Barclays up, Novartis is up, Lloyds is up. Lloyds and Barclays both, I think, probably representing that story that we talked about earlier. It looks like we are going to see additional levies being applied to UK banks by the Chancellor in the budget. The cost of that may be that you've got to talk up the budget. Maybe if you're a UK bank, I don't know, much being made of that this morning. So the UK banking story is positive. Shell's up, NatWest is up. So there's some UK stocks in there. In fact, the UK story is and the budget, kind of the preamble to the budget, is definitely represented in the market this morning, which I think is interesting.
It is. It's fascinating. And I think sticking with kind of the fiscal story, we're talking, of course, about the countdown to the UK budget. The conversation is happening in France as well right now. This isn't a massive move that we're necessarily seeing, but I think it's worth noting that just from an index perspective, the CAC 40 is the outperformer, higher by 0.3%. So, again, not a massive move. But we should point out that there were some headlines crossing earlier from the Socialist Party talking about French radio. Our colleague Caroline Conan, who, of course, is our French correspondent, saying that they have really been the linchpin in some of these budget negotiations. If they're saying that a budget is actually possible, that could be a game changer. I think the market may be still casting a little bit of a skeptical eye on that this morning. But
or already thought that.
Yeah, but still, France is the outperformer.
What I think is it's the French industrials that are up this morning. So you've got Airbus, Safran, Schneider. These are the kind of companies that are doing well. The banks are doing all right as well. Some of the luxury names less so. So LVMH under a little bit of pressure, Hermes under a little bit of pressure. So that's where you've got a kind of reasonably balanced market in terms of the French story. But there are definitely more up than down, like 30 up and 10 down.
Yeah, we don't see that. We don't see that very often in the French market, do we? Let's get a little bit more analysis this morning if we can. Hugh Gimber, global market strategist at JPMorgan Asset Management, joins us around the table. Hugh, pleasure to have you. We have a lot of, let's put the U.S. to the side for a moment. There's a lot of questions around the fiscal conversation here in Europe. We've got the UK tomorrow. We were just talking about France as well. There's also that tech theme in the U.S. What is the driver for European markets? The local issues or what's going on across the pond?
Good morning. The driver for me is fiscal policy. This all comes down to government's willingness to spend through 2026, in some ways independently of what the data is suggesting they should be doing. You look at the European growth backdrop, you look at the labour market, you look at inflation, there's really no strong need here for booming fiscal stimulus in 2026. But when you throw Germany into the picture, that's what we think we're getting. These are governments who have decided across the board, UK, France being two good examples, that cutting back on spending is politically unfeasible, and therefore the narrative for next year is about further spending. We can argue whether the deficits are too large. I mean, when we look at the numbers, we think really you have government spending at levels that imply we're already in recession, or perhaps we're already in kind of war phase. Obviously, that's not where the global economy is today, but with spend, the way we're framing this in our outlook for next year is about fuel in the engine. Governments that are continuing to power ahead with fiscal stimulus, and so we're focusing in European markets on the potential beneficiaries of that, whether that's the industrial story or potentially further upside for the defence names as well.
At the end of the day, though, they are still promises. They haven't actually hit the market just yet. So I am curious, to what extent is the under-delivering of that priced in?
So this is all about timing, and I think you hit on a really key point, which is that broadly, the consensus narrative for Europe next year is still very pessimistic. We're getting a lot of pushback on our positivity around the fiscal pivot, and that comes not just around question marks about Germany's ability to deliver, but also whether French or UK politics might derail the story. Ultimately, France, I think, are engaged in one big can-kicking exercise where all of the tough decisions are being pushed out to 2027. And in the case of the German story, we had the announcement back in February and March, and enthusiasm around that fizzled out quite quickly. But this is just an issue of waiting for that spending to start hitting the economy, which we think should be first showing up in the Q4 GDP data. So this story remains on track, despite lots of the excitement that has faded quickly over the course of the summer.
Hugh, will we continue to enjoy tech concentration in 2026, or will we try to protect ourselves against it? What's the strategy?
I'm not sure we have enjoyed tech concentration in 2025. I wouldn't say it has been. It's been so difficult for managers this year to position in what feels like a broadly diversified and broadly prudent way, and to keep up with benchmarks that are still being driven by a small number of names. So, if anything, I think we could enjoy next year hopefully a bit less tech concentration and some broadening out of earnings across a wider range of sectors. But critically, given how important US tech spend has become for economic growth, that broadening out is not about tech pulling back and others starting to take on that mantle. Rather, it's about a continuation of the tech capex story and others being able to benefit. So it's a broadening of AI, which then starts to drift into other sectors. I think the common narrative that many had at the start of 2025 about a tech pullback that would see others step forward is just very, very difficult to envisage here when tech has become such a critical driver, not just of the market, but the US economy overall.
And will competition start to be part of the narrative? Tech competition, competition amongst tech giants, will that start to be part of the conversation? Because it seems as if everybody's just gained, not everybody, but there's been a lot for everybody in 2025. Will that continue to be the case?
Absolutely, but I think there are three specific areas we're expecting to see that competition. So one is within the different buckets of the tech ecosystem. So look at the chip makers as one example. We're still not clear, I don't think the market is clear, as to whether or not in 5 years' time there's going to be room for many chip makers, or whether this is really a winner-takes-all type scenario. Same is true with the LLM providers. Are we going to need multiple different models, or is it actually going to be that one of Google or OpenAI or Anthropic turn out to be the ultimate winner? So that's, I think, competition area number one. Two is regionally. We've seen developments overnight with the US and China. I think really all that tells you is about China's key role in critical minerals that are so essential to tech production, and therefore the US being forced to make more concessions. And then the third is that balance between public and private markets, where we think the change in the structure of capital markets today that's allowing companies to stay private for much, much longer means that the balance of power within this AI story could be more tilted towards the private markets, because companies have just fundamentally changed their route to large cap. It no longer needs to go through small and mid cap. You can go private, 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 and then bang, a large cap IPO.
Hugh doesn't sound like he's worried about cockroaches, Guy.
I know somebody who is. I've just been kind of writing a few notes down. Governments are going to continue to spend. Central banks are going to cut rates. Fed's going to cut rates. Tech keeps spending. Inflation? So is that the biggest risk for next year?
This is one of the two biggest risks that we're flagging. We have a chart in the Outlook, probably my favourite, looking at consensus forecasts for inflation next year, which are broadly flat in the US, hovering around 3%. And we've overlaid that against all of the consensus forecasts through 21 and 22 that told you every time inflation rose, don't worry, this is the peak. Oh no, don't worry, this is the peak, this is the peak. And history tells us when you have excess stimulus in an economy, it typically shows up in one of two ways. In the 20s and the 90s, it was about asset price inflation. In the 70s and the early 2020s, it was about consumer price inflation. And so this is where I still think...
both at the moment.
Well, we have to a degree, but we have enough confidence in the labour market slowdown that we're not derailing.
Okay, so this is the 1920s.
So, well, I think there are definite echoes of the 1920s to today. For me, wage growth is key. Because if wage growth remains under control, if you continue to see that labour market slow down, the Fed can dismiss the pickup in US inflation that we do see ahead by saying we're more focused on our labour market mandate. If we're here in 6 months' time, inflation has picked up and the labour market is not only stabilising but wages are starting to accelerate, there you have a true test of Fed independence and you have the market getting a lot less comfortable about the inflation narrative. So diversifying against that pickup in inflation, I think, is absolutely essential, even though it's not our core scenario.
My kind of... If we go back to the 1920s, the Fed was a big part at the end of it in terms of what happened next. if the inflation is not coming down, is the Fed going to have to hike rates at some point? And if so, when could that come?
So in the interim, I think the Fed goes lower. Let's be clear. We should separate out.
So inflation's still sticky, but the Fed's going lower.
Yes, that is our core scenario for the first half of next year.
Yep.
You have an inflation pickup, but one which is contrasting with a labour market slowdown, and therefore this is still a Fed in cutting mode. It's where the labour market starts to turn that Fed narrative becomes far more difficult. Because look how they've justified
That's a 2026 story.
This is a 2026 story, potentially.
Okay. Yep.
Now, I think, again, you take into account Powell leaving in May.
Yep.
You take into account some softness in broader parts of the economy. This is not a red-hot US economy today.
Yep.
There's enough here for the market to look at the Fed cutting and say, this comes with risks, but we can understand why they're taking this position. If the wage story starts to change, that market narrative becomes more difficult. And so this is where alternative assets, your inflation diversifiers, are a critical part of a well-balanced portfolio, because it's not just your typical, are we going to be fine or are we facing a recession story? It's the inflation risk that I think is actually greater than the growth risk.
Hugh, nice to see you. Interesting charts. Worth a read. Hugh Gimber, Global Market Strategist at JPMorgan Asset Management. Thank you very much indeed. OK, let's take a quick look at the Core 6 this morning. Interesting market. Yesterday was the big day, but today, actually, there's some interesting gains still coming through. Defence stocks are up after getting hit hard yesterday. At this time, ASML is up, which is interesting. SAP's having a tougher time. Let's deal with the details of what is going on. Chloe Melly joins us now with a look at what's happening in banking.
Good morning, guys. So, yeah, ABN AMRO is up quite strongly this morning after announcing plans to cut more than 5,000 jobs over the next few years to boost profitability. This is part of a broader revamp plan for the bank, which also includes ambitions to become a top 5 private bank in Europe, as well as strengthen its position in Dutch retail banking. And this is a plan that is being welcomed very warmly by the market, and we are up 3.5% for ABN AMRO this morning. Moving on to defence, and we have also got a wall of green across the screen for defence after falling yesterday, and that is because the prospect of peace between Ukraine and Russia looks increasingly fragile. The two have exchanged heavy fire, and that is putting in question Trump's efforts to strike that peace deal between the two. And we have got that reflected across that defence industry this morning, with Rheinmetall and Hensoldt in particular up more than 2% this morning. Moving on to Continental, which is also up. The tyre maker is up because the European car sales have risen for the 4th month in a row, and that is because more affordable electric vehicles are being pushed onto the market, and so it is really boosting optimism for that car sector that has seen quite a lot of weakness. But we are up this morning 1.3% for Continental. And finally, Kingfisher, the owner of B&Q and Screwfix in the UK, boosted its profit guidance this morning, and we are up almost 6% this morning for Kingfisher on the back of that profit upgrade.
Chloe, thank you. Chloe Melly from our equities team. Coming up, we'll continue to focus on one of the stocks that is on the move this morning, EasyJet, down by just 0.8%, underperforming the broader market just a touch on the back of their numbers. Highlights from our conversation with the CEO next. This is Bloomberg.
Morning, welcome back. 20 minutes into a session that in some ways is going nowhere in a hurry after a massive day yesterday, though. I think we're just pausing for breath and reassessing the situation. Let's talk a little bit about some of the single stocks that we are watching this morning. EasyJet shares have had a really choppy ride this year. Part of that's been driven by kind of what is happening at the operational level. Part of it's been happening as a result of what's been happening on the M&A front. This morning, the stock is a little off after rising into the numbers that they've delivered this morning. Headline profit pre-tax for the full year beat the average estimate. Some of the other metrics were a little softer. We spoke to CEO Kenton Jarvis about the investment areas that he is focusing on for this business.
Because of the resilience measures we have put in, we actually saw an improvement in our punctuality, and we also saw, really pleasingly, that customer satisfaction increased by 4%, up to 80%, which is the highest level we've had in over a decade. And as a consequence, our resilience, our kind of disruption costs came down almost 50 million on an underlying basis. So the investments were made mainly in the second quarter to set up for the summer, and they really came through.
Kenton Jarvis, the CEO of EasyJet. Kate Duffy joins us around the table, Bloomberg's aerospace reporter, covering EasyJet for us. Good morning.
Morning.
What's the takeaway? What is the kind of read on EasyJet right now? Where should I be focusing on it? Is it the fact that the holiday business is doing well? Is it the fact that they're trying to get costs under control? Is it the fact that we're going to see more capacity next year? Where am I looking?
Is a bit of a mixed bag this morning. So as we've seen, the holidays business is doing really well. They've met their medium-term targets early, and that means that they've upgraded their target for about fiscal 2030. Their profit is good, it's looking up, but as you say, they've really struggled with their costs over this year, whether it be from the air traffic control disruption, that's caused planes and crews to be out of position, passengers to want refunds and compensation, so that's added costs. Also their Airbus deliveries as well, these were slightly slow, but what we're saying this morning is this growing confidence that actually they're stabilising. So they got the expected 9 aircraft this year, they're getting 17 next year. That's all in line with expectations, and that means that they can grow their capacity into next year by about 7%.
Kate, I've lost track of the number of times we've had stories, reports about people possibly interested in buying EasyJet. And when asking Kenton about it this morning, I thought I was going to get a really short response. I mean, I did in the sense that he says there's nothing to see here. But he went into a lot of detail about how all the flag carriers keep combining with each other. Seems not very interested in talking about where the low-cost airlines do. But we know that others in the sector have thought that it's a good idea. Michael O'Leary, for example.
Yeah, exactly. Michael is very outspoken about the fact that
the others should consolidate.
The others should consolidate. Yes, that EasyJet is this prime target for that. Also Wizz Air as well. I mean, there's lots of chatter in the sector, and as Kenton was saying, there's interest in the moment at TAP, the Portuguese airline. That's something that IAG, Lufthansa, Air France are all vying for. So it's a really sort of meaty airline consolidation environment at the moment. But Kenton said there's no plans for him at this present moment to be involved in that environment.
So what happens next? What do we think the winter demand picture is going to look like? What are we looking at in terms of the demand picture next year? We've got a budget coming up very soon. They obviously have significant exposure to the UK consumer. What is the message they are delivering in terms of what demand is going to look like and the health of the consumer?
Well, winter's always a really tricky time for airlines. Obviously, summer is when they make their most money. People are going on holiday. Winter's a little bit more subdued.
But that's changing a little bit, though, isn't it?
Yeah, he did say that fares are sort of flat year on year, but then going into Q2, which starts in March, they're slightly up a little bit. That's something that we probably do expect. But then next year, as I said, more aircraft's coming through, capacity is looking up. So it's...
So does more capacity equal steady fares, but more volume?
Yeah.
Well, presumably that must be the argument here.
Yeah.
OK, we'll watch that one with interest. Kate, thank you very much indeed. Kate Duffy.
All right, our Bloomberg Aerospace reporter, Kate Duffy, thank you so much. Let's talk about another topic. We are, of course, monitoring this time out of Brussels. The EU's antitrust chief has ruled out easing the bloc's tech rulebook. This comes after U.S. Commerce Secretary Howard Lutnick said Brussels needed to change its digital regulations in order to get a deal to lower steel and aluminum tariffs.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
Howard Lutnick there, the U.S. Commerce Secretary. Let's get a little bit more analysis from our Brussels bureau chief, Suzanne Lynch, joins the program this morning. Suzanne, we've heard this narrative before. Europe has too much tech regulation. Did Lutnick move the dial at all?
Well, I think it's clear that under this administration, there has been a renewed push for Brussels to roll back some of that regulation that affects US big tech. And Howard Lutnick made it very clear here in Brussels yesterday that he was linking these issues, that he was linking the call for laxer EU regulation on tech with a deal and further concessions on trade tariffs, particularly steel and aluminum, something that the Europeans want. So this is a real dilemma for the EU. I mean, the EU has always had huge power when it comes to regulating tech, both through its digital regulations and through its antitrust laws that are very, very powerful here in Brussels. But at the same time, it is said that is not negotiable. We heard from the EU Commission Vice President Teresa Ribera last night that the EU digital regulation is not for negotiation. European consumers borders would be protected. So the question is now how far the EU would go to roll back on these regulations, but the message seems to be from Brussels, not very far.
Right, yeah, Suzanne, it's interesting, isn't it, that the Europeans keep trying to say that these are not linked, that tech regulation and tariffs around metals and steel, there's no link between them. But do you get the impression that the US decides what's linked when it comes to trade policy?
Look, the reality is that the Trump administration does link issues. These technical trade talks are connected to them with the broader relationship between the United States and the European Union. Now, I mean, the European Union would say that it is already moving to pull back on some of its more stringent regulations. So, for example, last week it announced a digital omnibus package, it was called, which did decrease some of the reporting, some of the red tape around digital regulation. So the EU are trying to say, look, we're doing this anyway. We're pulling back on digital regulation. It doesn't just affect US companies, also our own companies in Europe have been complaining, and we're listening to them. So whether that will be enough to convince the Americans that the EU is changing its tune when it comes to digital regulation remains to be seen. Because at the end of the day, these fines that the EU have levied against US tech companies have been enormous, particularly on Google.
Suzanne, do you think there's a connection between what is happening on trade and what's happening on Ukraine? Is that going to influence the overall relationship between Europe and the United States and vice versa?
Yeah, in one way, the timing of this meeting in Brussels this week, I mean, it was a big deal having the US Commerce Secretary and the US Trade Representative attending the EU Trade Ministers meeting. That doesn't happen that often. And yet that coincided with a real crisis in the Ukraine talks, where their colleagues were scrambling to try and get in front of the Ukraine story, to get the ear of Donald Trump and try and influence this 28-point peace plan that had been circulating. So yes, the two issues are connected ultimately. That's politics. The EU is trying to keep the US on board on Ukraine, so it's trying to keep that relationship strong. Now, the Europeans also say it's got leverage. We heard Secretary Lutnick say in the clip there himself, it's a huge market of 450 million people. The US knows this. US tech companies know this. They know that they want to operate in these markets, and the EU say they have to play by their rules. So it's not that the EU has no power in this, but yes, I think the two issues are linked.
Suzanne, thank you very much. Suzanne Lynch, Bloomberg's Brussels Bureau Chief. Thank you very much for joining us. Coming up on the programme, we'll stick with the tech theme, in fact. We're going to be speaking to Dataiku's CEO about the artificial intelligence platform company that he leads, the role it plays in agentic AI in business, and the rate at which businesses are adopting AI. He is at the Adopt AI Summit that's currently underway in Paris. We'll check in on the AI theme next. This is Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session, green on the screen across the board. The outperformer, I think this is interesting, is actually coming here in France. CAC 40 higher by 0.3%. We don't say that very often. There's a political overhang over all of it, but it looks like some commentary potentially coming out of the Socialist Party there. Maybe, just maybe, removing some of that political hang in today's session. They're saying that a budget is possible. They were the linchpin. We'll see if it really moves the dial. But this morning, the French index is your outperform. But green on the screen across the board. Futures were showing a negative open, Guy. We've come back from that.
Yesterday was a party. Today's definitely kind of meh. That's what we're seeing in terms of the internals right now. Look at this. 312 up, 270 down. Nothing to see here. Volume is light. We're down. This is on a 20-day average as well. Is down by a quarter. More than a quarter. So this is a very unconvincing session in terms of what you're seeing in terms of the internals. But I guess you've got to see it in the context of yesterday. Let's talk about some of the leaders and laggards. Let's talk about the leaders first. Chips are up. SAP's down. We'll show you that on the next board, but chips are up. Barclays is up. UK banks look like they may get a reprieve when it comes to the budget. Shell is up as well, which is interesting. A little bit of volatility in the oil space recently. How low do we go, though? There were some interesting notes floating around on that story yesterday. Let's follow this up with the laggards because they are equally balanced this morning. SAP is down by 0.8%. Roche is down by 0.7%. 3i. Is that a UK story? I don't know, but it's down by 1.9% this morning. But it's a really balanced market. There's nothing really kind of obvious that gives us a clear vector, a clear sort of sense of direction this morning as to where we're going. Anna, what you got?
Yeah, in the meantime, let's get an update on some of the geopolitical news flow that we need to keep across, Guy. Bloomberg has learned that the Chinese government has instructed the country's airlines to reduce the number of flights to Japan through to March. The move signalling that Beijing is braced for a protracted spat between the two nations after the Japanese Prime Minister's comments on Taiwan caused disquiet in Beijing. Russia and Ukraine have exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Russia launched a wave of heavy air raids on Ukraine's capital, Kyiv, while the Russian Black Sea coast region suffered sustained suspected drone attacks. And Nvidia shares fell on a report that Meta is in talks to spend billions on Google's AI chips, suggesting the internet search leader is making headway in efforts to rival the industry's best-selling AI accelerator. According to reporting from The Information, Meta is in discussions to use the chips from Alphabet, known as Tensor Processing Units, or TPUs, in data centers from 2027. Meta may also rent chips from Alphabet's cloud division starting next year. Kriti?
Lots of big moves in the tech space. Of course, it comes amid this backdrop of this rally that we've seen, some of the corrections that we've seen, driven both to the upside and the downside by the tech names on both sides of the Atlantic. Let's bring that to a little bit local in terms of that tech conversation. Europe's biggest corporates are revealing their tech spending plans at the Adopt AI Summit in Paris today. Dataiku is one company hoping to lead the race. Its aim, of course, to build the integration of AI into everyday business operations. Dataiku CEO and co-founder Florian Duetto joins us now from Paris. Florian, a pleasure to have you on the program. Thank you so much for joining us this morning. As we've been talking about on the show today, but also for, I want to say, months and years, there's a lot of optimism around AI, a lot of investment in AI. Do you feel like the community and outside investors who are learning about this are maybe getting too excited about the prospect of adoption of AI into our everyday lives?
I think the AI market is incredibly early. I think if we are to compare to anything, building AI, building agents in 2025 is like building websites in 95. You're very excited, you're building lots of things that will have lots of value, but in the context of things, you're building websites without having invented yet the concept of blog post or the concept of e-commerce. So that's where we are in the market. That's why everyone is excited. Lots of investments are happening and lots of adoption is going on, but it's also a very early market.
Well, Florian, to your point, I love that you talked about 1995. It's certainly a parallel a lot of people are making. But to your point, there are a lot of websites that failed, a lot of domains that failed, a lot of technology associated with the internet that failed before they took off. What is the equivalent timescale here? It feels like a blog post we talk about all the time, but that's 25 years after the dot-com bubble. Do we have to wait 25 years for this AI bubble to manifest in real life?
I think the concept of AI bubble is related to investment in infrastructure, which is potentially unrelated to the fact that, in the grand scheme of things, enterprises are already finding value with AI. We have customers all around the globe, some of the largest companies on the planet, and they've been investing in AI, not just in terms of data centers or GPU or whatever else, but in terms of building application with AI, automating the way they manage their customers, finding efficiencies in terms of internal processes all around, finding 1, 2, 3, 5, 10% here and there. And I think that those efficiencies will compound over time, creating for companies the ability to actually find this value of AI that everyone is after. But indeed, it requires ambition. It requires to actually invest, not just in infrastructure, but it also in the transformation of the business.
Florian, good morning, it's Guy. You spend a lot of time in the States, you spend a lot of time in Europe. How is the perception of AI different on either side of the Atlantic?
I think that there is a difference in terms of timescale, in terms of speed of investment, where investment in the US is probably in advance in terms of how corporates are actually investing and adopting AI more rapidly. But I think what's common is that there is this problem of trust related to AI, meaning trust at every scale. Individuals are not sure whether AI is good for their job. Corporates are not sure whether AI will work, whether these agents will actually prove to be working versus not. And there is also a trust in terms of infrastructure, vendors lock-in, potentially technology that could be locked over time, creating for companies kind of like the trap associated to AI if they are not actually free to use any type of AI technology in the future. So you've got like trust issues at every level throughout the planet, even if speed of adoption is potentially ahead in certain countries, notably in the US.
Okay. Let's just kind of segment that a little bit. The labour market is clearly one area that everybody's watching for very carefully. Agentic AI and its impact on the labour market, what do you think it's going to be? People are worried about mass job losses. People are worried about a significant shift in the labour market. You're at the cutting edge of this. What do you see?
I think we are, again, too early in this market to make a call from a macro standpoint. But indeed, there is the potential of a significant augmentation of jobs. What I want to believe in, what I hope for, is that AI will be a way to actually spend less time over our keyboards and more time, well, human-facing. In the last 20 years, meaning our jobs have changed. Our jobs have changed from being like human-facing a lot to being screen-facing a lot. People spend time filling up forms with their fingers on their keyboards. Potentially with AI and agentic, you will find back augmented jobs where you find back this ability to talk to your customer directly, to favor human time. And I think it will be a profound change of the workforce, of course. This will be radical, this will be tough, but indeed, this is something that I think will be for the better in the long run.
Florian, so with that, I mean, would you expect to see, I mean, maybe I should ask a labour market economist, but would you expect to see job cuts in the short term, but maybe not in the longer term? Is that one way of thinking about this? I've seen that applied to other technological innovations over time.
I think there will be efficiencies in businesses. There will be a way to actually augment jobs to find efficiencies, and there will be new jobs being created with AI, new opportunities for revenue. We see some of our customers focus quite a bit on immediate efficiency, but others also looking at AI and AI technology through the prism of innovation. How can I actually put drugs faster on the market? How can I actually design an aircraft engine faster? Meaning this type of capabilities will actually lead AI to actually, well, faster economic growth, not just job cuts.
Florian, I want to ask you about the subject of tech sovereignty. And as a Franco-American business, I've seen your business described in such terms. Perhaps you have something to add on this subject. I mean, Europe worries quite a lot about the extent to which Europe relies on big tech names in the States. And maybe something about the politics of late makes that feel like a vulnerability. Do you get asked that by clients? Is this part of the conversation at all?
Yeah, it is. It is top of mind for every corporate on planet Earth, even some in the US, meaning they actually don't want to be locked with AI, to be locked to certain providers. And it's a matter of sovereignty. It's also a matter of controlling their costs in the long run. So they want to keep optionalities in terms of AI. It's about where the data is, about where my compute is. And most of our customers end up having a hybrid approach, where they mitigate the risk by having a multiplicity of vendors, American cloud vendors, on-prem, meaning GPUs they own and they can control fully, as well as data. And I think that those robust strategies, meaning are not obvious. It's not about like picking one vendor and making things easy, but it's necessary for a large enterprise in order to mitigate the risks. And it's, I think, something and an opportunity for building cloud capacity all over the planet with a multiplicity of vendors providing it.
Florian, we're getting close to Christmas. My tree's already up. I'm very much in the Christmas spirit. What is on your Christmas wish list in terms of making your company and the AI ecosystem in Europe a success? Are we talking about labor? Are we talking about energy, credit financing, cutting the red tape? What's on your Christmas wish list?
Oh, none of that. It's ambition. I think that in order to find the value of AI, and ambition is actually to some extent easier to get. Maybe you can't get it from Santa Claus, but you can get it from your art. So it's actually closer. I think that European businesses need the level of ambition matching American businesses. And in particular, in order to find the value of AI, you need to look at your most mission-critical processes, the big, heavy mammoth that you've got in your business, or you onboard customers as a bank, or you manage clinical trials as a pharma, or you manage all of your supply as a manufacturer. Those things cost hundreds of millions for most companies. They are like heavy information-driven processes. There is no way those processes are the same in 5 years for the leading companies on planet Earth. So as a company, if you don't change those processes today, if you don't start now, you will be lagging behind in 5 years. And then, actually, maybe we will find some economic impact of AI in terms of job cuts, but they might not be coming from jobs being cut by companies. It might be coming from companies failing.
Florian, thank you very much. Thanks for joining us. Good to get your perspective. Florian Duetto, the CEO of Dataiku, thank you for your perspective. Let us tell you what is coming up on the programme then. We continue to focus on the UK budget, of course, ahead of tomorrow's budget. We speak to Rupert Harrison, senior advisor for the UK. Well, he used to be a senior, he's a senior advisor for the UK at PIMCO, I should say. Previously has advised the UK Conservative government, of course. And we will get to a conversation with him shortly. This is Bloomberg. Welcome back. This is the opening trade, 45 minutes into today's session, Tuesday, 25th of November, and European equity markets not really going anywhere in a hurry. US futures pointing just a touch lower. Are we off earlier lows, though? I mean, yesterday was a stellar day, up by more than 1.5% in S&P stocks, up by more than 2% on the NASDAQ, but that was yesterday. Today is today. Let us move on to tomorrow. Investors will be keeping a close eye on UK markets tomorrow as Rachel Reeves makes her much-awaited UK budget statement. Joining us now, Rupert Harrison, senior advisor for the UK at PIMCO, former chief economic advisor to the UK Conservative government. Rupert, really nice to have you with us. Thank you so much for joining us. So, I mean, the bond market must be front and centre for everybody's thinking when it comes to the UK budget tomorrow. What does fiscal credibility look like, do you think, when it comes to the budget? What does she need to keep an eye on specifically to keep that bond market movement in check?
Yeah, I mean, I think there's been a bit of a risk premium priced into the bond market and probably the currency over the last few weeks because of all the speculation and particularly the U-turn on income tax. So I don't think she needs to do very much to see some of that sort of come out and a bit of relief in the gilt market. She needs to deliver on the fiscal plan. She needs to show that she has the political ability to raise taxes, maybe a little bit of spending cuts in the mix, but mainly tax rises, that she is going to deliver more headroom. I think the market is expecting a minimum of 15 billion headroom, ideally 20. Even that would be relatively small by historical standards, but it would be an improvement on 10. And then I think that the profiling of the consolidation is going to be quite important for credibility. So if it's all backloaded in those last couple of years, I think that might raise a few questions.
Yes, with similar numbers coming to us from the IFS earlier on when we spoke to them. They were talking about the 15, but also suggesting this in terms of the headroom, but also suggesting that this would be low by historical standards. I mean, wouldn't it just be a relief for everybody if it were substantially higher, and then the government wouldn't necessarily have to be whipsawed by daily moves in bond markets?
I mean, completely, but it's a bit like that old adage of, I wouldn't start from here.
Yeah.
So, the best decision would have been in that first budget to do more on tax and spend or whatever, the mix that she'd chosen, and give herself more like 30, maybe even, 30, 35 billion. That would be more comparable with the previous periods after previous changes of government, so after 2010 or the early Gordon Brown era, and gives you much more, leeway against changes in the forecast. The problem when you're starting with minus 10, which is probably where she starts before any measures, is that, every 5 billion is extremely politically painful. That's a lot of tax that you have to raise from a lot of people. And so what we've heard in recent days is that, 15 billion, I think, is the bare minimum, and I think the Treasury would love to get to 20 and to be able to say, well, we've doubled the headroom. I think that has a decent ring to it.
Yeah.
We had a conversation the other day with RBC Blue Bay, and the line there was that the gilt market won't believe anything this government says until it incredibly shows that it can cut as well as raise. That's true.
I'm not sure that's true in the short term, because I think the market has come to terms with the fact that serious spending cuts are really off the table while you have this Labour government, particularly because the Labour backbenchers are so influential given the U-turn we had on welfare. I mean, I think we will see a little bit on spending. We might see a tweak to the spending assumptions at the end of the forecast. That is probably on the less credible side. I think if we get some cuts to budgets over the next couple of years dressed up as if, efficiency savings, that will add to the mix. But I think the market understands there's got to be tax. And I think the test will be, is it tax revenues that the OBR think are stable, predictable, and will these tax rises definitely get through the House of Commons, which I think is much more likely with tax rises through the Labour Party than spending cuts.
Is this going to be growth negative or growth positive?
On balance, clearly tighter fiscal policy is going to be growth negative. I think we will see downgrades to the growth forecast, not least because we know the OBR is going to downgrade its trend growth assumptions. So I think we will see probably almost every year of the forecast lower growth. In a sense, that is good for the gilt market because I think that's going to create more space for the Bank of England to cut rates. And also, I think we are...
they're going to need to cut rates?
Well, yeah, certainly at PIMCO we think that the market is underestimating the need for rate cuts, particularly because the labour market is weakening and inflation is already coming down. And I think to the extent that we might get a surprise tomorrow in the budget, I think that more action than expected to cut inflation, bring down people's energy bills, fuel duty, I think that might be where the Chancellor would like to pull some sort of mini rabbits out of the hat.
Mini rabbits.
Tiny rabbits.
Forgotten the diminutive of a rabbit.
Going back to the growth picture, should growth still be a priority at this moment? You talked about what would be reassuring for the gilt market. Is it just about plugging the gap for now?
Look, growth should, of course, be a priority because when you're thinking about medium-term and longer-term fiscal sustainability and, of course, the growth in living standards that the government was elected to try and deliver, growth is absolutely crucial to both of those. But a prerequisite for growth is stability and predictability in policy. So I think that they have to restore fiscal credibility as kind of step one towards growth. And indeed, it would be, going back to the discussion about headroom, getting out of this 6-monthly cycle of speculation is really important for growth. Because it's been politically damaging, all this speculation, but it also has very real economic consequences in terms of frozen investment and the hit to consumer and business confidence. So, it's possible that this budget, if it does enough, could be a bit of a clearing moment for that uncertainty and speculation and then allow people to focus on a longer-term horizon.
Well, you mentioned the tax rises. Helen Miller over at the IFS earlier in the program had talked about that and called them delightful little treats, as in like a fun little combination of various tax rises. Is it just better to get one giant tax rise? How damaging would that be?
She wasn't a huge fan of the small little treats.
I know.
But she did call
a raised eyebrow, I imagine, when she said that. Look, clearly that would be better. And actually, that's not just the view right now. If you look back in history, in the UK in particular, but also other countries, in the UK, successful tax-raising budgets, so if you think of Geoffrey Howe in the early 80s, Gordon Brown in 2001 when the Blair government raised national insurance, Geoffrey Howe and George Osborne in 2010 both raised value-added tax. Those big levers, first of all, they raise the vast majority of revenues in the tax system, and they're also predictable. They raise revenue without big distortions. No one likes paying more income tax, but a big income tax rise is evenly spread, easy to forecast, and less distortionary and has less growth impact than some of these kind of capital taxes that I think we're going to get tomorrow. So clearly that would have been preferable, but in the end the politics has come down on the other side of that, and that's why we're going to get this, the word that is being used in the Treasury is this smorgasbord of a list of...
That's where the delightful little treats thing came out.
I know, but buffet,
exactly.
I always struggle with a buffet. Never know, it's always confusing, and I do wonder whether business is going to see it that way, that it's just going to be... it's going to get more complex, not less complex.
I'm taking you to a buffet after
We'll
the
do
show,
that. We can do that.
so I can teach you how to do it right. Rupert, but isn't the argument you're making on the tax piece, that completely undermines the growth picture, though? You're talking about trying to tackle growth in the medium and long term and incentivize it, while also advocating for the giant tax rate. Aren't those contrarian measures?
Look, I clearly think that the market and most economists would prefer more of the emphasis to be on spending, particularly the less productive parts of spending. So I think that they would like to see serious welfare reform, for example, particularly in areas like health and disability benefits where you've got a very rapidly rising bill. So even limiting the increase in that, not even reducing the spending, would be a really good start, and that would be good for growth, good for confidence, good for credibility. If the assumption is that's off the table, all we're left with is tax rises, and then it's a question of minimising the damage.
All we've seen so far is fewer Mercs and BMWs, but we'll see whether we get in more detail on that. Let me ask you more seriously about AI and whether the UK, we haven't got time to do justice to this subject, but is the UK going to be well positioned to make any productivity gains that are available to it from AI technology, do you think, Rupert? Given it, the service nature of the economy, does that make it a good thing or a bad thing?
Well, a very heavily service sector economy has been a real problem for productivity growth for many countries, but particularly the UK, because some of those services have been very stubbornly resistant to process and process changes and innovation. And I think the big hope is that AI can be a real transformational technology in services. I think the UK is relatively well positioned because it also has a good AI sector in terms of, particularly around London, but also some other parts of the country in terms of some of those big firms are located in the UK. There's a big skill base. Yeah. So the UK should be relatively well positioned and also should have a little bit more flexibility. So this could be one area where actually the flexibility of Brexit allows the UK government to set a regulatory framework for AI that is perhaps a little bit more permissive than the rest of Europe. So it should, if done right, be relatively well positioned.
Can I ask you the tricky question around all of this? Is the gilt market going to focus on the kind of the growth aspect, the kind of what happens with the economy when it comes to this budget, or is it going to focus on what it means for Rachel Reeves' political career and whether or not she gets replaced by somebody that is further left than her, whether the government gets kind of changed and there is a further left government? Which way, what's the most important bit here?
So I think that's a really good question because I think that the most that the budget can do is settle the kind of short-term nerves now. And I think, as I said, I think it can be a short-term clearing moment by getting back on track with the fiscal path. But the reality is, and I think this is what underpins your question, that over the last couple of weeks, the genie is out of the bottle now about Labour leadership. And about the markets are now talking a lot about what is the probability that Keir Starmer and Rachel Reeves won't be here in a couple of years' time and you'll have a different leadership in the Labour Party. And I think that clearly creates risks. And therefore, you have seen that particularly in the kind of longer end of the gilt curve. I think that premium is going to be much harder to remove. And something that maybe we'll be living with for the foreseeable future.
OK, something to keep in mind then. Rupert, thank you so much. Thanks for joining us. Rupert Harrison, Senior Advisor for the UK at PIMCO and former Chief Economic Advisor, of course, to the UK government. We have a lot of programming on this subject tomorrow. UK Chancellor Rachel Reeves is expected to deliver her budget 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. And it doesn't stop there. The opening trade will break down the numbers with key business and political voices in our budget special. That is Thursday in the cold, just for you, Thursday morning.
With a beautiful view of St. Paul's Cathedral. We're very excited about it. In the meantime, we are seeing these markets kind of mixed. Green on screen in Europe, red in the States. That does it for the opening trade. The Pulse is up next. This is Bloomberg.